Good morning. As the sun rises over New York City, the heart of global finance is already buzzing with news that could ripple across the world. Today, we're diving into a story that's sending shockwaves through Wall Street and beyond. We're starting with a major shift from one of the world's most influential banks, JP Morgan Chase. This isn't just another headline. When a financial institution of this size makes a move, it can set the tone for markets everywhere. For months, financial experts, including those at JP Morgan, have been forecasting that the Federal Reserve would cut interest rates in December. This prediction shaped expectations for investors, businesses, and everyday consumers alike, fueling hopes for lower borrowing costs and a boost to economic activity as the year winds down. But in a surprising twist, JP Morgan has now reversed its forecast. The bank has officially pulled its prediction for a December rate cut, signaling a significant change in its outlook for the U.S. economy and monetary policy. When a financial powerhouse like JP Morgan changes its mind, the entire financial world takes notice. Investors, traders, and policymakers are all recalibrating their strategies in response to this unexpected announcement. So, what prompted this sudden reversal? The answer lies in a wave of new economic data that's painting a very different picture of the U.S. economy. Recent reports show that growth is not just steady, it's accelerating, with key indicators running hotter than most experts anticipated. The main catalyst behind JP Morgan's decision is a much stronger than expected U.S. jobs report. The labor market is showing remarkable resilience, with job creation numbers far surpassing forecasts and unemployment rates holding near historic lows. With the job market booming and wages continuing to rise, JP Morgan's analysts now believe the Federal Reserve will see little reason to cut rates in the near future. The Fed's primary concern is keeping inflation in check, and a hot job market can make that task even more challenging. For consumers, this means borrowing costs, on everything from credit cards to mortgages and auto loans, are likely to remain elevated through the holiday season and possibly well into next year. The dream of cheaper loans and lower monthly payments will have to wait a little longer. Anyone hoping for relief from high interest rates, whether you're planning a big purchase or just trying to manage your monthly bills, will need to be patient. The financial landscape is shifting, and flexibility will be key for households and businesses alike. This isn't just a story for Wall Street insiders. The impact of these decisions reaches into every household, affecting how families budget, save, and spend. From the price of groceries to the cost of financing a new car, these changes touch all of us. The story of the past year's economy has been full of twists and turns, and it's far from over. As we look ahead, the decisions made by institutions like JP Morgan and the Federal Reserve will continue to shape our financial future in ways both big and small. So, what's really driving this sudden change of plans? We'll break down the key factors, the potential risks, and what it all means for you. Stay tuned as we unpack the latest moves from Wall Street's biggest players and what they could signal for the months ahead. Let's clarify. What are interest rates and why do they matter so much in our daily lives? You hear about them all the time in the news, but what do they actually mean for you, your family, and the broader economy? At its core, an interest rate is simply the cost of borrowing money or the reward for saving it. When you take out a loan, whether it's for a car, a house, or even just using your credit card, the interest rate determines how much extra you'll pay back on top of what you borrowed. Think of it as the price tag attached to money itself. The higher the interest rate, the more expensive it is to borrow. This affects not just big purchases, but also everyday spending and saving decisions. For example, if you're shopping for a new car or considering buying a home, a higher interest rate means your monthly payments will be larger, and you'll pay more over the life of the loan. Even a small change in rates can add up to thousands of dollars over time. But who decides where these rates should be? That's where the Federal Reserve, often called the Fed, comes in. The Fed sets a key interest rate that acts as a benchmark for banks and lenders across the country. When the Fed raises its rate, it becomes more expensive for banks to borrow money, and they pass those costs on to businesses and consumers. This means higher rates on everything from business loans to personal credit cards. The Fed uses this powerful tool to try to keep the economy balanced. If inflation is rising too quickly, the Fed may raise rates to slow things down. If the economy is sluggish, it might lower rates to encourage borrowing and investment. High interest rates tend to cool off spending and investment, making people and businesses think twice before taking on new debt. On the other hand, low rates make it easier to borrow, which can boost spending and help the economy grow. The Fed's decisions don't just affect Wall Street or big corporations. They ripple through every part of the economy. From small business owners trying to expand, to families budgeting for groceries, to students paying off loans. That's why every move the Fed makes is watched so closely by investors, businesses, and everyday people alike. A single announcement can send shockwaves through the stock market and change the financial outlook for millions. Understanding how interest rates work isn't just for economists or bankers. It's essential for anyone who wants to make smart decisions about borrowing, saving, and investing. The more you know, the better you can plan for your financial future. Why should you care about interest rates? Because they directly affect your money. Higher rates mean bigger payments on mortgages, car loans, and credit cards. If you're a saver, higher rates mean better returns on your savings accounts and CDs. But if you're borrowing, it's more expensive to carry debt or finance big purchases. Interest rates also influence job security. When borrowing is costly, businesses may slow hiring or cut jobs. The Fed tries to balance controlling inflation with keeping the job market healthy. Every rate decision impacts your budget, your savings, and your job prospects. That's why these headlines matter. Let's see what's driving the latest changes. The big reason for JP Morgan's change? It all comes down to a single, powerful piece of news that sent shockwaves through Wall Street and Main Street alike. The latest U.S. jobs report, released by the Bureau of Labor Statistics, has become the talk of the financial world. Every month, this report gives a snapshot of how many jobs were created, how many people are looking for work, and what that means for the broader economy. Economists and analysts had been bracing for a slowdown, expecting that hiring would finally start to cool after months of steady growth. But when the numbers came in, they blew past even the most optimistic forecasts, leaving experts scrambling to update their models. The U.S. economy added far more jobs than anyone predicted, showing a labor market that's still red hot. Offices are bustling, factories are humming, and businesses of all sizes are still looking to hire. Unemployment stayed low, meaning most people looking for work are finding it. For job seekers, this is a rare moment of opportunity, with more openings than applicants in many industries. This is great news for workers: more jobs, more security, and often better pay. Many employees are seeing raises, promotions, and new benefits as companies compete to attract and keep talent. But for the Federal Reserve, this strong job market is a double-edged sword. It's a sign the economy isn't cooling off yet, which complicates their plans to lower interest rates. A strong job market means less urgency to cut rates. Investors and businesses hoping for cheaper borrowing costs may have to wait longer, as the Fed keeps a close eye on these robust employment numbers. The Fed has said it will respond to the data, and this data says, no rush. Policymakers are signaling patience, watching to see if the economy will slow on its own before making any big moves. Cutting rates now could risk reigniting inflation, which has already been a major concern for families and businesses dealing with higher prices at the grocery store, gas pump, and beyond. That's why JP Morgan and other major banks are rethinking their forecasts. The unexpected strength of the job market is forcing everyone to reconsider what comes next for the economy. The jobs report changed the conversation overnight. Suddenly, predictions about interest rate cuts, inflation, and economic growth are all being revised. As we move forward, let's look at what this means for the bigger economic picture and how it could impact your wallet, your job, and the future of the U.S. economy. A strong jobs report is like a health check for the economy, and this one says the U.S. is in good shape. When businesses hire, it shows confidence in the future and fuels consumer spending. More people working means more money flowing through the economy. But if hiring is too strong, wages can rise quickly, pushing up prices and fueling inflation. The Fed wants steady growth, not a wage price spiral. This report suggests the economy hasn't cooled enough for the Fed to cut rates safely. It's a delicate balance. Keep growth strong, but don't let inflation flare up again. That's the challenge facing policymakers right now. So how does a strong jobs report change interest rate predictions? The Fed's main goals are maximum employment and stable prices. With jobs booming and inflation still a concern, the Fed can afford to wait before cutting rates. Think of it like a doctor keeping a patient on medicine just a bit longer to ensure full recovery. JP Morgan and others see no emergency, just a reason for patience. Cutting rates now could undo progress on inflation. The most logical move? Hold rates steady and watch the data. That's the new consensus. JP Morgan isn't alone. Other Wall Street giants, like Morgan Stanley, have also scrapped their December rate cut forecasts. This isn't a rogue opinion. It's a new consensus. When multiple major banks change course together, it signals a real shift in the economic outlook. Markets react quickly. Stocks, bonds, and the dollar all move on these expectations. Higher rates can weigh on stocks, but boost the dollar. Now, all eyes are on the Fed's next meeting for clues about the future. The big question has shifted from, will they cut in December, to, when will cuts finally come? Wall Street's new baseline is set. Let's talk about what's next. With December off the table, when might rate cuts actually happen? JP Morgan now expects the Fed to start cutting rates in early 2026, possibly as soon as January. They predict a second cut could follow in April, signaling a slow, cautious approach. This gives the Fed time to see more data on jobs, inflation, and holiday spending before making a move. If the economy cools and inflation keeps drifting down, cuts could begin. But forecasts aren't guarantees. Surprises can always change the timeline. If inflation sticks around, cuts could be delayed even further. For now, the consensus is, don't expect relief before 2026. The Fed is watching and waiting. So should we. So, what does all this mean for your wallet today? High interest rates are here to stay through the holidays. Savers can still lock in great returns on savings accounts and CDs. Borrowers should plan for higher costs, pay down debt, and budget for current rates. If you're hoping to refinance or buy a home, patience is key. The journey back to lower rates is taking longer than expected. Stay informed, manage your budget, and make the most of high savings rates while they last. That way, you'll be ready whenever the rate cuts finally arrive.